So remember I talked about the AICPA. One of the responsibilities of the AICPA is that they are responsible for the Code of Professional Conduct. So they put out the Code of Professional Conduct, which guides the professional conduct of CPAs. And so for CPAs, the Code of Professional Conduct, if they violate the Code of Professional Conduct, there can be actions taken against them, but it is the framework for which they are to adhere to. So the code goes from very general standards to very specific standards. So as you could imagine, those standards that are pretty general, such as the principles of professional conduct, which basically says these are the ideal behaviors and attitudes that an auditor should have, are somewhat more difficult to enforce. They're not enforceable because, think about it, it's ideal attitudes and behaviors, right? So one of the things you struggle with, for example, you say things like auditors should exhibit an appropriate amount of professional skepticism. Well, you only have hindsight to kind of really determine, and then it's professional skepticism. And actually, I was just on a conference call today because I'm on this. The PCAOB has all of these research synthesis teams that they've kind of come to the academic community and said, you know, we want to get more information. We want to know what research is out there. These are problems that we're seeing as a result of, our inspections. And, we want to know more about what's going on. And you guys do research, so we want you to help us out with this. And so I'm on a team that's looking at professional skepticism. And one of the things that we're finding as we're looking through the literature is that it's kind of all over the place in terms of what are the risks to professional skepticism, when are auditors not sufficiently skeptical, what does that mean that they're not skeptical, do they even know to be skeptical, is skepticism a trait or is it something that's learned? So, we're looking, it's a very difficult concept. So you'll see sometimes if you read an inspection report, it'll say throughout the inspection report, lack of professional skepticism. This auditor didn't exhibit an appropriate amount of professional skepticism. There was an audit failure because there wasn't professional skepticism. Well, that's very general. And what they're going on is they're assuming the auditor's behavior was due to a lack of professional skepticism. So it would be very difficult to enforce, if at all. Rules of conduct are the minimally acceptable standards. So we'll talk, independence is a rule, is considered a rule of conduct. Right, so we'll have Rule 101, and it has very clear standards about what auditors should and should not do. So those are the bright lines. When we talked about independence and appearance, you could look at the rules and see, did the auditor meet the criteria under the rules? Yes, he did, or she did, or no, she didn't. So they're specifically enforceable. Then there are interpretations of the rules of conduct as well as rulings by the Professional Ethics Executive Committee. And these are not specifically enforceable, but departures have to be justified. So there's a rule. So for example, let's say under the rules of conduct, auditor departs from that, and they try to provide justification as to why they departed, and the justification might be reasonable. It might indicate an exception to the rule. So that would become an interpretation of the rule. So these are basically answers to questions regarding the rules of conduct, and then rulings by the Professional Ethics Committee, the same thing. So it's not that it's looking at mitigating circumstances or maybe unique situations. Basically, overall, the principles of professional conduct deal with responsibilities, the public interest, integrity, which you will hear a lot of with respect to auditing. As you read standards, you will see that word used a lot. Objectivity and independence, same thing. Over and over again, you're going to see that the use of that word. due care, and then the scope and nature of services. So basically, it is the responsibility of members, auditors, CPAs to exercise sensitive and moral judgments in all activities. They have to remember they're acting in the public's interest, and that they respect that and honor that and recognize that they're serving the public, that they have integrity for all of their, with respect to performing their responsibilities. They have to be able to maintain the public confidence. So again, think about how if there's an audit failure, what the reaction is by the public when there's a significant audit failure. The public, there's this whole lack of public confidence after we saw the failures of Enron and WorldCom and just a series of accounting failures and auditing failures. We saw what kind of opinion the public had about the public accounting profession or about CPAs. Objectivity and independence. Members should be objective, independent, and free of conflict of interest. So the more enforceable rules that are, for example, with respect to independence and appearance, you can't have direct interest in your client. Okay, there's services that are prohibited that an auditor can't perform for their client. So if for their audit client, okay, so if it's an audit client, you can't perform. There are a number of consulting services you cannot perform, and this is aimed at making sure that the auditor remains objective. So imagine if an auditor had stock or direct financial interest in their client. It could be possible that they can conduct an objective audit, but the perception is going to be probably not, right? You might not believe it. You probably think, I don't believe that. Due care, that the members should observe the standards, and remember, we had under the general standards that they have to use due care in performing their responsibilities. And then scope and nature of the services just basically says that the auditor in practice has to abide by and follow the rules of the Code of Professional Conduct, or observe the rules of the code. So we're going to look at why is this not working? Oh, I know why. Do we have to set it up here? Okay. The last class, it just opened up for me. Okay. Oh, you need to do something? Okay, what's going on? Mike? Is it? Okay. Okay, let's pause this for a minute. Yeah, I had it all the way up. Should it be Mike? No, it should be. Oh, is this thing? Doesn't matter. Oh gosh, I hate this place. It's not muted, is it? Mm-hmm. And I had no problem. No, still nothing. Okay. Okay, well, while we're trying to get audio, let me do this. We have these cases that we're going to go over in class next week. And there are two separate cases. So some groups are going to get one case and other groups are going to get another case. But you need the background material to prepare prior to class. So I'm trying to do this in an organized manner. So I need a representative from each group to just come and get a package and pass it out to their group members. Because if I don't know who's in your group. So I just want to, okay. Now, Now, also, it's important for you not to share your information with the other groups, please, because it'll defeat the purpose. Okay. Did everyone? So it should be 5 in each packet. Do you have a group? Okay, so I need to get you in a group. So who do I have that does? Now this is a good way to find out who. So look, you don't have a group. Who else doesn't have a group? No, I got you. Okay, so I'm gonna put you in a group with. You still have no audio? Okay. What's your name?
Sadiq, last name Sadiq, S-A-D-I-K.
And what's your first name?
Nourdine, N-O-U-R-E-D-I-N-E.
E-D-I-N-E? Mm-hmm. Okay, so I want to introduce you to, and I'm going to try to get some other people. Love that. And David? I was trying to call you Jason. Okay, so we have. So you guys should exchange emails, and I have to get you 2 more members. Okay, so you want to exchange. You don't have a group either? Oh, you have a group, right? Okay. You don't have a group? Okay, so you should exchange. So Shin, David, Lavette, and Nadi. Mm-hmm. Okay. Okay, good. So, Levette, could you do me, did I give you 2? Could you do me a favor and email, and then could you email me with everybody? Okay, thanks.
I don't know.
Okay.
I don't think that's it. Hey, you can do a favor here. What?
You're filmmaking, you don't even know how to turn on the camera?
Oh, okay.
Do I look okay? Serious, Ben, if I don't get an A on this project, I'll never graduate with honors. I won't get a job. My parents will take me out of the house. My whole life will be a failure.
Relax. Only about to get an A. 3, 2, 1.
Hi, my name is Teresa Irwin. This is a video essay for my auditing course. Today, we will be focusing on the importance of being independent. Can you put the title right here?
Yeah. Got it.
Can you get to the campus too? Independence is a cornerstone of the public accounting profession, and my goal today is to answer 4 key questions. Can you put graphics in the side panel?
Just in case you're wondering.
Why is independence important?
No, they have. I have to just get you the clients. Yeah. Some people have clients, some people have auditors.
You can't do it in here with one camera, Teresa. Film 101. Adam's the best cameraman I know.
Okay, you say so. I'm going to do an intro, okay?
Quiet on set!
Oh, not on set.
Quiet! Action!
We are now outside the office of Professor Ira Kaufman, a recognized expert in the field of auditing and independence. He's done some interesting research I hope he'll share with us. This view was 20 minutes. Hi, Mom. I'm really busy right now. Can I call you back? No, of course. already do. Okay, I have to go. Bye. Hi, Professor.
Teresa, one of my favorite former students. To what do I owe this pleasure?
Well, I'm doing a video essay for my auditing course on the importance of auditor independence.
Excellent.
I was hoping I might be able to interview you, if that's okay.
Come in. I assume these folks are your trusted cameramen?
Yeah, this is my boyfriend, Ben, and this is his friend, Adam.
So let's proceed. What are your questions?
Oh. We learned in class that the independent auditor protects the public interest. So what exactly does that mean?
Well, let me start here. Do you like baseball?
Not really.
I do. Sorry.
Okay, well, you don't need to be a fan to appreciate this. You know what an umpire is, right?
Yeah, of course.
Well, auditors are a bit like umpires. Their job is to enforce the rules of the game. They can't root for one team over the other. To an umpire, it doesn't matter who wins or loses, only that everyone follows the rules. The outcome of the game does not affect their judgment, because their loyalty is to the rules, not the team. We could say they are independent. In the same way, auditors must also be independent and not be influenced by their clients.
That makes sense.
Now, imagine a baseball game with no umpires, or even worse, with umpires who place bets on the outcomes of games they officiate.
That would not be good. The Fed would definitely protest.
Exactly, Ben. Just like an independent umpire protects the integrity of the game. Without them, the sport would self-destruct. Independent auditors help protect the public interest.
Are you getting this down? The camera's on, right?
Yeah, don't worry.
Okay. And what exactly do you mean by public interest?
Public accounting plays a unique role in a free market economy, and its focal point is the public interest. Essentially, the confidence in a company's financial statements when it knows that an independent, knowledgeable third party, the auditor, provides reasonable assurance that the company's financial statements are accurate. That way the public can trust the information it's getting.
And by public, you mean?
Public consists of investors, banks, vendors, customers, and the overall business and financial community. Basically, anyone who wants to rely on a company's reported information and is counting on the objectivity, integrity, and professional skepticism of the public accounting firm.
Professor, could you speak just a little bit more on professional skepticism?
Sure. When an auditor exercises professional skepticism, he should question what a company tells or shows and independently corroborate the information by analyzing it very carefully and asking probing questions. Just like a pitcher might think he threw a strike and the hometown fans might agree, the umpire must rely upon his own vision and judgment.
I know that you have written a lot about the importance of independent audits in capital markets. Could you tell us a little bit about your research?
Yes, as a former student, you may recall the set of market exercises we used. In the exercises, students assume the role of a buyer or a seller of two hypothetical commodities, gold and fool's gold. Now, gold, of course, is very valuable, whereas fool's gold is totally worthless. The students start with a cash endowment, and the buyers use it to try to buy gold as cheaply as possible, while the sellers are trying to sell their inventories of gold and fool's gold. The sellers want to sell as much of their commodities as possible because any of their inventory at the end of the exercise will become worthless. The buyers cannot tell the difference between the gold and the fool's gold. The buyers, therefore, must decide whether or not to trust the sellers. Are they selling the fool's gold as gold?
I remember. And in the first exercise, the buyers had to take the seller's word for it.
Exactly. And what happened? Well, the market for gold collapsed because the buyers were so worried that they would be tricked into buying the worthless fool's gold that they largely refused to buy anything at all. In that scenario, everyone suffered. In the second exercise, we appointed an independent auditor who attested to the accuracy of a seller's claim, signaling to a buyer whether or not the gold was likely to be real.
And what happened?
The market thrived. Buyers were motivated to buy, and the sellers sold. It's just human nature. If you don't trust the quality of the information a salesman is giving you, you won't want to do business with them.
And the third exercise? Now, let me see. If I remember correctly, there was still an auditor that who wasn't independent. So he couldn't be trusted any more than the sellers, and the outcome of the exercise is similar to that of the first exercise.
That's correct. The market collapsed fairly quickly, once again. So we know that for our markets to be successful, the buyers must trust the information they receive from the sellers. As a real-world example, if you are buying a share of my company's stock, and I, as the seller, give you information to help you determine what that share is worth, you need to be able to trust the accuracy of that information. That's where an auditor comes in, to attest to my assertions, and that is why it is absolutely essential that auditors be independent and be perceived as independent by the public. That is the buyers.
And that is why the public accounting profession has so many rules about independence. Professor, do you know how these rules came about?
That, Teresa, is precisely why they invented libraries. Now, off you go.
All right.
That's correct.
You're almost done.
I'm starving. I know. It's citizen library.
I was hungry.
Okay. Keep it away from me. I want to get thrown out. One more minute.
That's what you said at home ago. I didn't hear the check.
You didn't say much, does he? You can really learn a lot from him. In order to fully understand the importance of independence, we need to know a little bit about the roots of the public accounting profession. Well, the profession, as we know, has a long history going back into the 19th century. It really emerged and took its place as a critical part of the financial market in the early part of the 20th century, right around the stock market crash of 1929. The crash created severe turmoil and outrage and shattered any trust investors had in corporate America. In 1933, to restore people's faith in the financial market, Congress created the Securities and Exchange Commission, the SEC, and introduced landmark securities laws requiring companies to provide financial information to the public and have their information audited annually by independent certified public accountants. The SEC has the power to oversee financial reporting, including the public accounting profession. This supplements the already important role that both the AICPA and the State Accountancy Board have and continue to have in establishing rules for CPA. Now, they say history repeats itself. And at the turn of the 21st century, it did just that. Leading corporations such as Enron and WorldCom with billions of investors and employees' dollars stable. And public trust was shattered again. To restore public confidence, Sarbanes-Oxley became law. And the Public Company Accounting Oversight Board created.
That's good. Can go with that.
It's too general. I mean, it sounds good, but what does that actually mean to the people who have to be independent?
Oh, no, I do that looking now.
Well, let's go to the cafeteria. Come on, you can bring it up.
Okay, so let's just kind of digest that and think about independence and integrity. Remember the Code of Professional Conduct: integrity, objectivity, and just take a moment, read through this question, and then let's talk about some of the implications of this from the banker's perspective. Okay, so now putting yourself in the shoes of the banker, how do you think this situation, how would that influence your decision? What are some of the things that would give you pause? Right, so you wouldn't have any faith in the auditor's opinion? Yes. Right, you would assume that the audit opinion is biased. Because at this point we don't know that it's biased, right? But this, right, so this would be an example of, you know, people, you can't tell, you don't know if anything went wrong, but you would have concern. Any other thoughts? Yes.
It would first see what the report has to say and see how biased or not biased it was.
But how would you know that from the audit report?
This is the report, and if she's only talking good about it, then I would be concerned, and she might think that she, you know, is doing a favor to them. But if it has one or two things that are visible, and you know, I see that she is also showing me the negative side and the positive side.
Well, now let's back up, because let me just address that for a moment. The audit report is a standard report, right? So the only thing you're going to see as the banker would be the financial statements that the company prepared and the auditor issues an opinion on, and then you'll see the auditor's opinion, which basically in this, I think they said the auditor issued an unqualified opinion. And so that basically says the auditor says the company compiled the information in accordance with GAAP, and that the financial statements are free of material misstatements. That's all you're going to see as the banker. So the auditor doesn't present an overview or an opinion about whether there's some things that were good and there's some things that were bad. You don't get that. I'm glad you brought that up, because I'm going to, in a moment, talk about something the PCAOB is doing regarding that. Yes, Mike.
This situation happens all the time, so I would assume, I obviously don't know much about the couple at all, about the lady, but I would still go with it, not knowing anything else, obviously, but obviously I knew something about the lady for the company. I might change my decision, but I would still go with it.
Okay, so if you would still go with it, what recourse, what might you do differently? Would you do something differently? Even you'd still extend the loan, but would you do something differently?
Maybe put restriction on it.
Right.
Something else.
Right.
A guideline.
Right. You could add debt covenants or something like that. Did I see another hand go up? Okay, I want to talk you actually raised a good issue. Point. because the PCOB has been pretty active since they came into existence, and they're really trying to address this issue regarding transparency of the audit process, and really trying to close this expectation gap or address some of the issues that users of financial statements have regarding the information that they really are getting from an audit report. So the expectation gap says that people think that the audit report is more than it really is. So, for example, they think that the audit will uncover fraud, and that's not the case. But along those lines, what the PCOB is trying to do, or looking at alternatives to the standard audit report. And just recently, they issued a concept release, and what that means is they're seeking opinions from the public, from users of the financial statements, audit firms, any interested party to comment on these proposals. And what this proposal is suggesting is 4 different alternatives to the standard audit report as it is today. One of the things is an auditor's discussion and analysis section. So you've all seen annual reports, and you've seen management's discussion and analysis of their company. Well, the PCOB is suggesting that what about an auditor's discussion analysis, which kind of gets to some of what you pointed out, that it would go beyond this standard one-page report that says the audit is in accordance with GAAP and there are no material misstatements. It would start to get into the black box for the public, because the audit process is a black box for the public. So it would get into that black box and says this auditor would then comment on things like that. So, for example, they wouldn't say this was negative, this was positive. They would disclose where the audit risk was. So what areas in the financial statements or what areas in the client's business presented an audit risk or increased the auditor's risk? How did the auditors respond to that risk? So what audit procedures did you use to respond to that risk? What did management do? So in other words, let's take an obsolescence again. Let's stay with that, an obsolescence reserve. The auditor said, should be 1.4 million. Management said it should be $1 million. We came to this conclusion. Either we recorded the financial statements reflect $1 million, or the financial statements reflect 1.2 million, or whatever that resolution process was. They have to disclose that. Management started here, we started there, this is where we ended up. I'm paraphrasing, but it's getting at those kinds of things. What are the significant accounting policies and areas that that the client has? So in addition to the standard audit report, it would be what they call this auditor discussion and analysis section. So there is some talk. It's just a concept release now, but because there is that concern amongst the public that the audit report just doesn't tell them enough. It's just a pass-fail, so that they want more information. So I don't know. Obviously, audit firms are not happy about that. So I could only imagine what their responses will be in terms of whether or not this is viable. But if you're interested in it, the PCOB website has a lot of really interesting information about some of the things that they're, changes or things that they're thinking about, or releasing call for research or just comments on some proposed changes to the auditing report, as well as other things like the audit process. Another thing that they're looking at doing is, I think I said this before, now partners have to rotate off the engagement after 5 years. They're looking at rotating firms off. So while a company still hires their auditor, after a certain period of time, they would have to put the audit back out for bid, and that auditor can no longer bid on that client. So they'd have to go through another cycle. So they'd have to change auditors every 10 years is one thing that they're throwing out. I think I've seen 7 years. So it's really interesting to look at the PCOB, because they're really being very proactive about addressing some of the issues that have come up with respect to the audit profession. Okay, so we concluded that the bank, if you're as a banker, you probably wouldn't have a lot of confidence. You would wonder if there was any bias and whether or not you could rely on it. Some people would say, I'm not going to issue the loan because I don't trust the information. Some people, they would issue the loan but put restrictions on it. So again, this is to point out that if you don't have this idea of independence, if you don't enforce independence, or what's going to happen is that the information is going to be not valued. And so from the banker's perspective, their information risk is higher because there's this question about the independence or the objectivity of the audit report. So, as I said, the banker is obviously going to be concerned about the auditor's objectivity, whether it's unconscious or conscious. They're going to be concerned about it. And this is what we consider, right, when you don't know, you can't get in the black box of the auditor's head. You don't know, and there's tons of research in the audit behavioral literature that talks about biases that auditors consciously have and unconsciously have. In fact, Danielle has a brilliant dissertation that's looking at biases and how to mitigate those biases in an audit setting. She has a unique approach to it. But from the psychology literature, just as human beings, we have biases that we're not even conscious of, and it impacts how we respond to things. Okay, so as a result of that, it might impact our objectivity. Same thing with professional skepticism. Some people are just inherently skeptical, regardless of the fact that they're in an audit environment. They're just skeptical in everyday life, right? Those people are going to approach an audit, if they become auditors, they're probably going to approach it a little differently, and maybe a lot differently than someone who's not skeptical. There's this debate, or there's a line of research that kind of looks at whether or not you're skeptical inherently just because, as I indicated, you're just naturally a skeptical person. And so now when you find yourself in this audit environment, your skepticism increases when you because of the environment. Or are you a person who you're not skeptical, you're not, you're somewhat trusting, and but can you learn to be skeptical? Can you learn that given the environment of audit and the issues that you may face, the risk that you face as an auditor, can you learn to be skeptical in certain situations? Can it be taught? And so that's an empirical question we don't know, and which is why the PCOB is trying to get get auditor, the academic community to kind of focus on professional skepticism. So obviously the bank is going to be concerned about that. They're going to be concerned that the auditor's judgment could be biased, which someone pointed out. So for example, did the client engage in very aggressive accounting practices and the auditor allowed that treatment because they were biased or because they were not as objective? And then, as pointed out, the last point pointed out that, yeah, you can still give them the loan if that's what you decide, but you would want to insulate yourself from that. So if a company is risky, right, that doesn't mean that investors won't invest in that company, because some people are very, very risk-seeking. But a company that risk is priced, right? So for a very risky company, as an investor, if you're willing to take the risk, it's usually because there's a higher payoff, right? You're going to be compensated for that risk. What the standards setters are saying is that with an audit, if it's risky, then tell me it's risky. If it's a problem, tell me it's a problem, so that I can, as an investor, I can insulate myself against that risk. I can decide that I want to take the risk and you're going to have to pay me a higher return, or if I'm risk averse, I'm not going anywhere near that company. I'm not parking my money in that company, right? But let's level the playing field so that I know that. So a banker can obviously insulate themselves against that risk by putting in covenants or conditions or requiring a much higher interest rate from the company. Okay, any questions? Right. Okay, so let's look at one more here. Okay, where is it? So let's just take a look at who is, what services are prohibited and what relationships are subjected to independence. Yes. Where's the... Oh, there's one on that side? Okay.
I still have none of the real world stuff. A top drop right in this research and why it's important. But I still don't have any critical information. Like, how does independence affect a person's finances, business relationships, investments? You learn this from grad students? I just have her. She's so busy, I'll never get into sleep. I can't study yet, Ben.
What?
I didn't want to have to do this, but yeah, I really don't have another choice.
Dude, what are you talking about?
He'll see. If he says something, can you tell him to stop?
What about food?
So I'm assuming this is an accounting firm,
Yep.
and you're just gonna barge right in there and start interviewing people? Are you out of your mind?
Trust me.
Do you have a friend that works here or something?
Come on, hurry up, both of you. Don't worry about it. Excuse me, young lady. Just what do you think you're doing here?
We made a wrong turn.
And who are you, young man? This is Ben, remember? Ben? Oh, Ben! So nice to meet you finally. I've heard wonderful things.
You have? What? You two know each other?
Ben, I'm Teresa's mother. Pleasure.
Hi.
You didn't tell him? I didn't think he'd come if he knew.
Wow.
Well, what a wonderful surprise. And who are you?
So you've already interviewed a number of people about independence. I don't understand why you didn't come to me in the first place, as I am a partner in a public accounting firm.
Well, I didn't want to bother you.
You couldn't if you tried.
Thanks, Mom.
And I'm thrilled I got to meet your boyfriend finally. And, Adam, is it?
Yeah, nice to meet you too, Miss Irwin. And Adam, well, he doesn't say much.
So I've gathered. Okay, here we go.
Ready.
There are 5 areas where independence may impact your life as a member of the public accounting profession.
Ben?
Got it.
In each of these areas, there are rules to help ensure that you and your firm remain independent. The first area is financial interests. Let's say you provide services to a company. You would not be able to hold any shares of stock, bonds, stock options, or any other investments in that company. The only financial relationships with that company, such as IRAs, trusts, loans, credit cards, and depository, brokerage, and insurance accounts may also be restricted. So you must be mindful of all your financial interests, as you and your close family may be restricted from having these with an audit client or an affiliate of an audit client.
A restricted entity?
Yeah, exactly.
Go on.
The second area is business relationships. For example, if you participate in a small joint investment and one of the other investors is a member of a restricted entity board of directors,
Yeah, that would not be permitted because professionals of the accounting firm can't have a joint investment with an audit client or a client's officers or directors or major owners, right?
that's exactly
exactly right. And you also have to be really careful about accepting gifts or discounts from a restricted entity, right?
Yes, you should never be indebted to an audit client in any way. Now, the third area is employment relationships.
Obviously, you can't work for the client.
Right. And I may not be able to provide services to an audit client if my husband, your father, or another member of our family works in a financial or executive role as a client.
I get it. Because otherwise, if you work for the client, you might be checking the financial statements that your family member has to create, which would definitely be a conflict of interest.
The fourth area is the scope of the auditor's services. You see, certain types of services can impair auditor independence. Let's say the accounting firm determines how to account for a transaction in a company's financial statements. Well, then the firm will then be auditing its own position, not the client. In essence, the firm created the information that it will audit.
So, what's another example of a service that could, under certain circumstances, impair independence?
Well, an auditor should create the audit client's account records, make payments for the audit client, or represent the audit client in a legal case. Management must do its job, so the auditor can do theirs with an independent mindset.
And the last area?
Fee arrangements. Things like contingencies, where the audit firm is paid according to the results it delivers. For example, if the firm got paid only if a business strategy it suggested succeeded, the firm's objectivity could suffer. Auditors sometimes have to make tough decisions and push back against the client's accounting methodologies or assumptions. So if they are conflicted, they may be concerned about rocking the boat and jeopardizing their relationship with the client.
So using your example, you may be left willing to question the client's accounting because both you and the client stand to gain financially.
That's exactly right.
So what happens if you make a mistake and you don't get those independence rules right?
Well, it is essentially your responsibility to comply with the rules, and there may be repercussions for violating the independence rules. Depending on the specifics, action can be taken against both the individual professional and the firm. Therefore, you need to make sure you report all financial interests and employment and business relationships for you and your family to the firm. It's also your responsibility to keep that information current. So, accounting firms have policies and tools in place to help you understand income rules.
Thank you so much for being with us, Mom. This has been so helpful.
Of course. And I'm thrilled I got to meet your boyfriend. As you now know, these restrictions apply to family members as well.
Mom?
I'm just saying it's important for your video that spouses and even spouses equivalents have to comply with independence rules too.
Oh my goodness. We have to go.
These are serious issues. Maybe we should talk more about them, just Ben and I.
What are spousal equivalents?
Come on, guys. Right now.
Well, you can think of a spousal equivalent as someone who shares a committed relationship with a professional, like domestic partners where marriage may not be an option, or couples that live together but don't marry. Some relationships are so similar to marriage that they create the same types of independence conflicts on with spouses. So right now, Ben better not be a spousal equivalent. But in the future, you never know.
Okay, really, honey, you have to go. Bring Adam.
Bye, sweetie. Dependence too, husband.
Camera off.
Does she need to summarize?
Later.
No, I thought she was funny.
This is not your mom.
Independence is an essential element of the audit function. As a member of the public accounting profession, you have an obligation to be independent. The independence rules fall into 5 basic areas: financial interests, business relationships, employment relationships, scope of services, and fee arrangements. If you join an accounting organization, whether you work in an audit, tax, or consulting, you will be required to comply with the rules in these 5 areas. To be successful, public accounting professionals must act with integrity and objectivity, and auditors in particular must exercise professional skepticism in their work. Accounting firms provide a unique and important service to the public. Through its independent audit reports, the profession helps to protect the public's interests and benefit the financial market by helping to ensure the fairness of corporate financial business. How was that?
Great.
Okay. Okay, so just to summarize, obviously direct financial relationships are prohibited from, the auditors are prohibited from having a direct financial relationship with their clients or interest in their clients, and also any material indirect. So that's when a covered member has a financial interest in an entity that's associated with the attest client. And the attest client, meaning the audit client. So they give examples of mutual funds and stock funds. So what the key point that in the last video that the partner pointed out is that the firms, this is really important for firms. And so remember when we talked about quality control standards at firms, this is a part of their quality control, is to ensure that their employees understand the independence, to monitor this, to track it, to find out, to constantly make their employees aware of the importance of adhering to independence. So they'll send out questionnaires or reports that employees have to fill out on a regular basis to ensure that they don't have, that they're aware of it and that they don't have any financial interest or any of their close relatives have financial interest in the clients, audit clients.
So back to current relationships or past relationships?
So I mean, if you had stock at one point but you no longer have it, no, it's current. So as long as you don't have stock in the company, then it's not an issue. So prohibited financial relationships and prohibited business relationships. So the CPA can't perform a managerial or any other significant role because it would put the CPA in the what's the word I'm looking for? Position, of auditing their own work, which obviously that would not be objective and independent. So if a partner or employee is a professional, leaves the firm and is subsequently employed by the client in a key position, that's usually prohibited, but unless there are conditions that are met. So for partners, I think there's a cooling off period of a year. If they're going to a client in a key managerial position, a financial reporting position, there's a cooling off period. Some of the things that should be done is that audit programs or approaches and procedures should be changed, because the idea here is that because you can't stop people from working for a client, you can't prohibit employment, but there are rules that they have to follow, and as I said, there's a cooling off period. But they also expect that the firm is going to realize that there's a chance that in the perception of bias or that independence has been violated is out there. Whether it happens or not, there's this perception. So that they should take steps to ensure a third party that might look at it and to indicate to the public that, you know what, we realize the partner went to work, even though it's been a year, we've changed audit procedures, we've done, our audit testing, our audit approach, we've amended all of those things. Okay, so, because there's a lot of information, obviously, that a partner would have about the audit process that they can now bring to the client. There are a lot of things that the client has no idea about the auditor's decision process. So, for example, they don't know about what materiality level that the auditor has set. They don't know what areas the auditor has deemed to be most risky. So the client doesn't have access to the audit work papers. But now if you have a partner go over to work for the client, there's obviously confidential information about the audit process that they could share with the client, and so the audit firm should respond to that by making changes to their audit approach. I won't go into detail about this, but it's important to realize that this does extend to families as well. So it's not your second cousin, your third cousin, you know, it's your wife, a spouse, or a significant other, children. So I won't go into detail. The chapter goes into, has a table which identifies family relationships. So just make sure that you understand it. The important takeaway here is it's not just limited to the CPA. There are family relationships that are also covered under the independence rule. Also, and I'll go through these quickly because the biggest, obviously, is the financial relationship, business relationship, and family relationships. If you're being sued, basically what this is saying, if the auditor is being sued, then by the client, how are you going to be objective? So not actually, if you're being sued, you're probably not going to be auditing the client anyway, but any litigation that the client forms against you can impair your audit independence. So as a result, at that point, you should withdraw from the engagement. Okay, this is basically dealing with prohibited services, which I think in the video they touched on. But basically, you can't be in a position of auditing your own work, right? So you can't, the SEC and the AICPA rules will allow for bookkeeping services, but they won't, if it's a private company, that's one thing, but for publicly held companies, it's not allowed, right? So clients have to accept full responsibility for financial statements. The CPA has to must not assume the role of an employee or or management, and the audit must conform to GAAP, basically. So for publicly held companies, you can't do that. For privately held companies, there's some ability to do that. For our purposes, we're going to approach this from a public company perspective, so those kinds of services are prohibited. Okay, this already. Okay, this is what I was wanted to cover as well. For audits of publicly held companies, partners have to rotate off the engagement after a 5-year period. Prior to the PCAOB, firms had their own, I think it was 7 years, but after SOX, I think they reduced it to 5 years. So partners have to rotate off the engagement. So firms will have this whole transition type of process in place, because if you imagine that you have a client, and especially if it's a large client, you want to make sure that that transition is seamless to the client, because the last thing, I mean, you are providing a service to your client, and it's important to maintain, good client relationships. So you don't want 1 year there's one partner, and then the following year, boom, there's a whole new partner having to learn the client engagement. So most firms have this transition type of process in place because they know that they have to rotate a partner off after 5 years. That partner cannot have any responsibility on the engagement. They're rotating the engagement partner off. If a partner is offered a job by a client, there's a 1-year cooling off period. If they're going to the client to work in a financial reporting oversight role, they can't. They have to wait 1 year before doing that. What's the magic number about 1 year? I don't really know, but that's the rule, right? It's a 1-year cooling off period. Also, in response to that, as I pointed out before, the firm should be doing things as well to say, okay, now we have a former employee working at the client. We want to make sure that we provide this that we are impartial and we show that we're impartial and unbiased, so they'll do things to adjust their audit approach. So they shouldn't go in with the same necessary audit approach and audit procedures. They should be doing things to address the fact that they now have one of their employees working for the client. And if you recall with Enron, this was one of the things that the regulators cited, was the fact that there were so many former Anderson people now working for Enron. Right? So there was this, in their mind, there was just too much coziness. As Enron and Anderson had become one almost, with the amount of employees that former Anderson employees now working that had begun working at Enron. So it's a real concern. A firm is not independent, obviously, if the auditor's partner's compensation is based on selling engagements, because what they're concerned about here is that now you have incentives, right? If your compensation is based on the fact that you, how much audit services you can sell to that client, well, you're going to really try to sell to the client. And so you're going to do things to keep that client happy, keep the business coming, and so as a result of that, the thought process is that could impact your objectivity. So those are that's not allowed. That would impact independence. And then there has the SEC has again, the audit committees were always around, so it's not that audit committees are new because of Sarbanes-Oxley. The accountability placed on audit committees are highly emphasized and required under Sarbanes-Oxley. It was not stated before, now it's very much so stated. So audit committees are to take a very active role in the audit engagement. So they can't claim deniability. Oh, I didn't know. They can't say that. They can't throw their hands up and say that, because the rules require that they have to have communication. There has to be communication between the auditors and the client's audit committee. So, for example, the audit committee hires the auditors. So after the year in engagement, auditors have to meet with the audit committee and talk to them about the results of the audit. What kinds of issues came up with respect to the audit? How were they resolved? Why they were resolved the way they were resolved? What kind of what kind of interaction they had with management? Did management fight these adjustments? Why did they fight these adjustments? Those kinds of things. So the audit committee has to be kept fully involved in the process, so they can't claim deniability. Yes. No, the partner on the firm keeps the client, but the partner has to rotate off. So each engagement has an audit partner assigned to it. So that audit partner is called the engagement partner, and he or she is responsible for the audit, and they're the boss, and they sign the audit report. Every 5 years, if it's a publicly held company, they have to rotate off. They can no longer be the engagement partner, the lead partner on that audit. Right, the individual auditor. The firm retains the client. One thing that's being considered is now the firms will also change. Oh, no. So they rotate off, right, and they just go on to another client. If the client makes an offer to them, right, there's a cooling period, 1 year cooling period. It's whether they were on that client 1 year or on that client 5 years. If the client makes an offer and they accept, it's a 1 year cooling off period. Technically, what happens though is firms will say to, and this is harder to control, but firms will say to their clients, please do not extend any offers to, staff without, speaking to, so let's say I'm a manager on an engagement. The partner in talking to the client and management, that's something that they discuss, please don't come to me first. Let me know that you're going to do that. Alert me that you're going to do that, because they're concerned about, you're talking to my staff, you're talking to the people, and I'm relying on them to do this audit. So if a firm approaches a staff person or a manager, it is that person's responsibility to kind of go to the partner or somebody in the firm's office and say, look, you know, they made me an offer and, you know, either I'm considering it, I'm not considering it, doesn't matter, you should alert somebody so that they know. But most firms have that understanding with their clients, so a client would never even approach you without first having discussed it with the partner. And hopefully they would do it after, they shouldn't do it during the audit engagement, but that's not something you can control. You know, you go in to talk to the CFO and he goes, you know, I really like you, why don't you come work for me? What are you going to do? Right? So just quickly, we're not going to spend a lot of time on these, but there are other rules of conduct which I kind of summarized in the earlier slide, but integrity and objectivity, general standards, and we talked about these a little bit, professional competence, planning and supervision, due professional care, sufficient evidence, making sure that 202 deals with compliance with standards. So for this, just make sure, I'm not expecting you to memorize these standards, but just be aware that there are more standards than Rule 101. Rule 101, I want you to know inside and out. Rule 101 is independence. You've got to understand independence, okay? But these other standards, just make sure you understand that they're there, you know where to go. So you know that there's a general standard on, you know, the characteristics of the auditor, behavior auditor, just be aware of those. But I'm not expecting you to memorize every single standard. For Rule 101, you need to know Rule 101, which is independence. Just quickly about disciplinary actions. First of all, CPAs, the license for CPA is granted by that respective state. Okay, so none of these organizations, AICPA and PCOB, can grant you your license. Okay, that's only granted by the state, and the state is the one that can revoke your license. However, you do. The AICPA does have a professional ethics committee, and they can take remedial or corrective action. So they can terminate you from AICPA membership. They can take trial board actions, or they can suspend your AICPA membership. That doesn't necessarily mean that you will lose your license. It will definitely depend on the severity. But it's not the AICPA that can revoke your license, only the state. We already talked about quality control. Okay. All right. So that covers independence. We didn't talk about ethics because we're going to talk about that next week, but that covers independence. So what I want to do now is talk a bit about professional skepticism. So I want you to just, does everyone have the case? If you need love, get a puppy. So could you pull that up or out if it's on your... All right, so everyone has it up or out? So what was this? So somebody told me, give me a 2-minute overview of the, 1-minute overview of the case. What's this case about? Certainly not about a puppy.
In this case, there is this CPA who wants to go and audit courthouse and how they pay money. But the lady who works there, that's his best friend's wife. and when he's in the auditing process, he sees that there's a cash receipt missing and he cannot reconcile that particular entry. So when he checks with the woman, she says that, oh, she found the money lying between the registers. And she gives him hard cash and says, here's the money, we just forgot to deposit it the next day because it was late entry. But when he was looking at the cash, he thought that the entry was from 2005, but the money that she gave him, the bills were printed in 2006. So he knew that she was faking and she's been doing something wrong the whole time. So he did report it as fraud, and then she was sent to the jail, and later she had invited him over and said, thank you for correcting me and showing me the right track.
Okay, good summary. Joanne, did you want to add something?
Well, basically, I think, like, you can see at the beginning that he's kind of nervous. He was one of his first audit by himself.
Right. So there was some pressure. There was some pressure.
And he didn't really like approach his, I think it was
the partner. He was a senior, I believe.
Yeah, and but at the end, I think he was determined to make the right decision. So it's like uncover the lady, even though she was like a really close friend.
So that would make, and so do we see any independence issues here? What are they? Yes. Right, so there was a challenge right there, right, okay, what else? Right. His personal relationship with both her and her husband. Yes, Natasha. Right. He did not. He showed professional skepticism. In which way? How did he show? What actions? What were the skeptical actions that he showed? Because he did exhibit professional judgment. Skeptical judgment, right? What were the actions?
Yes, he confronted.
Right. He confronted her, right? Love it.
He didn't just accept her story. I mean, she said that, the money, was lost between the residents.
Right.
He didn't just accept her story. He checked the bills.
Right. He did additional. Right. Right, he did that.
I think the first step is initially identifying the fact that the police money was material.
Right.
He had materiality.
Right.
That was the first thing that he thought of when the money was issued, when he was reconciling and everything. Right. I think that's the first hint that he was going to be skeptical about everything. Since it was, number one, because it was the first audit, but then that issue itself.
Right.
Because he could just took the 320 account and clear, boom. And even if not reporting it, it was immaterial to him.
Right.
But he took on the personal things to clarify that.
Right.
So I think that's the first step to show his professional skepticism.
Exactly.
He was also taking the signatures. One was in second and one viewing.
Right.
They were at the same day.
Right. Now, Natasha and then Ricardo. Right. He went to his supervisor. Right. Right. So he sought out guidance. Ricardo, what you?
I was just feedback on that. Like before you saying the auditors staff, you said planning.
Mm-hmm. Right. So he was very thoughtful about things, and I want to put the thing here was right. His independence could have been impaired, right? It could have been because he had this personal relationship with. So he didn't have independence in appearance, right? In the sense that we could check off all the boxes. He didn't have any direct financial interest or anything like that. So you could check off, and certainly his best friend doesn't qualify as a covered member, right? The woman, I forgot her name, the fraudster didn't qualify as a covered member, right? So for independence in appearance, he was independent. What could be challenged was he independent in fact? And I think we would conclude that he was independent in fact, right? The reason he was independent in fact is because he did not allow his personal relationship with the husband and the fraudster to impact his judgment and keep him from following through on things that these fraud indicators or red flags that cropped up as he was going through the audit, right? So this is a good example of how you can be independent in appearance, and had he not followed through the way he did in the case, he would have not been independent in fact either. Because she's not a covered member. She's not a covered member. So, right, so that's why, even though they had the relationship, but she's not a covered member, but he also went to his partner. And the partner he worked with says, there's not a relative, but we're good friends. And, I just want to make you aware of it. Do you think? So he was from the start being very concerned about independence and appearance and how it might look. He wanted to, he felt he could be objective, and I think he proved that he could be objective, right, in his actions. But he did go to the partner and disclose that relationship, even though that relationship did not impact his independence, right? Even if, from an appearance perspective, she's not a covered member, the friend is not a covered, they're friends. People develop relationships. Especially if you're on an audit client for, ever, and you've been on that audit client and that's one of the concerns that regulators have, is that auditors are, especially larger clients, you are there all the time, right? You have offices sometimes. Some of these large clients, the audit firm has a dedicated office, area, not just one office, an office area. When I audited mobile way back when I was an auditor, we had a whole section of a building, right? That's how big the audit was for the firm that I worked for. So we were in kind of one section, on the same floor as the financial people, but we had our own area that we had keys to and so forth. We would leave stuff there. So you're there every day. You're never in your office. You're always at the client. So you're going to develop relationships. And that's, so under independence and appearance, the rules per se, you're independent. But it's how those relationships impact your judgment and your behavior that could render you not really being independent. So what's professional skepticism then here? What kind of skeptical thing? So do you let me put it this way. So do you think audit procedure is to compare the ink? Is it to compare the dates on the currency? That was him going above. That's getting additional information, gathering further evidence. He did not only look for evidence. He wasn't only looking for confirming evidence. He also looked for disconfirming evidence, right? He went over and above looking. So once he realized it or felt that there was a problem, what did he do? He performed additional audit procedures. He went basically outside of the box. Now maybe, we don't know because we don't have any profile of him, right? But maybe he was just skeptical by nature, but whatever it was, maybe he was being overly careful because he knew that, he had this relationship and he was really wanted to make sure that he appeared impartial, that he showed that he was impartial and objective, so he was very careful. It was his first audit on his own, so he was very careful. He was reporting directly to the partner. Whatever his reasons, he was extremely careful and went over and beyond normal audit procedures to find out if it was really a fraud. He followed it up and communicated upward as he was supposed to do. So let's talk about And that's what professional skepticism would suggest. If you're truly being professional, if you're exhibiting professional skepticism. So take a moment to read through. So which one of these defines professional skepticism? What do you think? Any ideas? Which one do you more strongly identify with? So I have B. Skepticism means the auditor makes a critical assessment with a question in mind of the validity of the audit evidence obtained and is alert to audit evidence that contradicts or brings into question the reliability of documents and responses, blah, 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 blah. You get the gist. So most of you identify with D. I heard another one. D. Professional skepticism is the propensity of an individual to defer concluding until the evidence provides sufficient support for alternative explanations. And identify with any of the others? Mike? I think you might be right, Mike. And the other hint might be standard. Right? So some of these are research papers, but that's done, looked at people in a laboratory setting and, put them in situations where you would, to invoke professional skepticism and see how they responded to that. But it really is all of the above. The only one, and this is just my personal opinion, the only one that I'm not so sure that it is the opposite of trust. Because I think you can trust a person, right? But, you don't trust maybe an explanation that they're giving you. And maybe that if they do something to cause you to maybe question their trust, you start to distrust them. So, I'm not saying that this isn't, I just, off the face of it, I don't know that I would automatically jump to C, but technically it is all of the above, right? Those are all of the characteristics, at least A, B, and D are definitely all of the characteristics you expect an auditor to display. Yes.
C doesn't it include, doesn't it illustrate the intent? If your skepticism is already distrustful, doesn't that go against being independent by what was it? Mind-wise? Because you know how you have a bias? Now that's what that was, right?
Mm-hmm.
Mental bias. Or you have mental bias and negative notion if you're already distrustful at the beginning.
But so I understand what you're saying, but it doesn't have the same effect, right? Of if your bias leads to you making, uncovering something up for the client. But I understand what you're saying. You could have a bias. The result is, though, right, you're pessimistic. So the impact, though, from an audit perspective on something like this is that you over-audit, or you just spend so much time, trying to figure out if the client, committed a fraud that you miss stuff because you're not focused where you should be. So this clearly is, you don't want somebody who first of all, you can't go into your client, if you go into your client like, I don't trust you guys, you're all thieves and liars, you lack integrity, then that shouldn't be your client, if that's the way you feel, because you're never going to establish a relationship. You want to build trust with your client, and that doesn't mean that you believe everything they say, that you don't question them, that you don't challenge them, that you just accept everything. That doesn't mean that. That just means that you feel like you're dealing with people who have integrity, but you're suspending judgment, right? So you treat each situation as an independent situation. So, because a client can be, you know, a great client today, right? And then you go in next week and the circumstances change, and now they have reasons to commit fraud, or they have reason to manage the financial earnings of the financial statement. So, in short, all of these have are characteristics that you would expect the auditor to exhibit within reason, obviously. So basically what the auditing standard states is that the audit has to be performed with an attitude of professional skepticism, that the audit team has to meet and talk about the need to exercise professional skepticism. When we talk about fraud, we'll talk about SAS 99, which deals with the auditor's responsibility with respect to fraud in a financial statement audit. And one of the components of SAS 99 says that the audit team has to get together and brainstorm. They have to talk about where fraud could occur. Not that it did occur, but where it could occur, and as a result of that, develop their audit procedures to address that fraud risk. As a part of the planning process, you have to do that, and audit teams have to get together and talk about that. It's important for the audit partner, the audit manager, those senior individuals on the audit engagement team to talk about the importance of professional skepticism. Just quickly summarizing, I talked about some of the initiatives the PCAOBs had, and most of those initiatives are driven by the fact that what they believe is auditors are not exhibiting enough professional skepticism. They're not sufficiently skeptical on audit engagements. What the SEC enforcement actions, and they're called AAERs, what they found in a 10-year period, this was as of 1990, ending in 1997, that auditors fail to exercise due professional care in 71% of the cases. Remember, due professional care falls under the general standards, so an auditor then has violated generally accepted auditing standards, right? That also, they failed in 60% of the cases to maintain an attitude of professional skepticism. More recently, the PCAOB's inspection reports as of 2008 found that the 8 largest accounting firms, so not just the big 4, the 8 largest accounting firms, that the deficiencies they found, the issues they found on those audits were related to a lack of professional skepticism. Now, keep in mind though, I had a little inside information being on the PCAOB team as we're looking at this and discussing these things with them, is that it's kind of broad. What they're saying was a lack of professional skepticism, which is one of the reasons why they want to do this research synthesis. Because if there was an error or they disagree with the auditor's, opinion or judgment on something, they write it up as a deficiency. They consider it a lack of professional skepticism. So they attribute a lot of things to a lack of professional skepticism. And one of the challenges we have is the fact that you can't be skeptical if you don't recognize a situation where you need to be skeptical. So it might not be that you lack professional skepticism, it's that you didn't even know you were in a situation that that should have raised your skepticism, right? So it's not always as black and white as, okay, there was an audit failure or the auditor made a bad judgment, they didn't have show professional skepticism. There's some really interesting work that's out of not a part of the accounting literature, but certainly literature that audit researchers draw from on conscious corruption or unconscious bias. And this is taken from Baserman, and he doesn't do audit work, but he has done some work on this kind of how auditors are kind of in this. They can't help themselves. It's not that they're consciously corrupt, that they're consciously making bad decisions. It's just that because of the environment that they find themselves in, they are paid by the clients. They have all of these time pressures. They're trying to satisfy their clients. You have people who are really don't have that much experience. Maybe they're 1 or 2 years out of college, and now they're faced with sometimes with very complex transactions. They might not be getting all the supervision that they should be getting. So there's a whole lot of stuff that could contribute to these biases. It's not that auditors are just bad. Okay, so it's not that auditors are bad, and they point out that the audit failures rarely result from the fact that auditors are deliberately colluding with their clients. That's not usually what leads to it. Right? A lot of it is that they have a really difficult time psychologically being unbiased. That it's not a conscious bias, it's an unconscious bias is what they're trying to say. But I've noted here, it's a really interesting way to look at alternative thoughts about why we see some of the audit failures we see. The other thing, and we're going to talk about this, go into this a bit more next week, but there's this auditor-client relationship that drives it as well. So we see some of the things that the regulators have put in force. Clients, partners have to rotate off the client after 5 years. If they can't work for a client for a year in a key financial reporting oversight role. The PCAOB comes in and they do inspections, so you have this third party coming in and kind of providing some hindsight. Some of the things that they're talking about as in terms of audit firm rotation. So the auditor-client relationship in itself just breeds this familiarity, which then can have a significant impact on auditor exhibiting professional skepticism. It's just human nature. And just, I've found this was in 2004, and I think it's pretty relevant today. What the research is finding has found is that auditors audit staff people. So that first 1-2 years that you're in public accounting, you're more willing to confront the client. And when I say confront, I don't mean you're in their face like, look, you know. You have a questioning mind. You suspend judgment. You look for disconfirming evidence. So you look at the ink and compare it, okay? So audit staff are the most willing to confront. Seniors are much less willing. And keep in mind, you become a senior after 3 years, right, in most cases. So seniors are much less willing to confront, but become more willing in a high risk of fraud situation. So if they're placed in that situation, and it goes, like danger, 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 it's fraud. So once they realize it's a high risk area, their skepticism goes up. So they just immediately go into skeptical mode, right? But they have to be placed in that situation. Managers are less willing to confront, and particularly when the risk of fraud is high. So what does that create? A problem because seniors report to managers. So seniors have now become more skeptical in these high-risk situations, and managers become less skeptical. So who dominates in there? Partners are sensitive to fraud motivations, except when their client is very important to the firm for fee or referral. So all of this seems to suggest that there needs to be more training to make people more aware of these biases that they bring to the table and how it could impact their audit judgment. So next week, we're going to continue along this and talk about ethics and talk about professional skepticism.